A warm welcome and good evening to all the participants. Thanks for giving your time to JM Financial to hear us out on our monthly webinar. So, first of all, I would like to share my PowerPoint presentation with you. So it's a very small presentation which will help you take you up with the roadmap for the month of February. The key pointers which we would like to cover in this short webinar is how would you approach the month of February if you are a short-term trader. We would also discuss the positions which are rolled over from the January month to the February month. How are the institutions placed or positioned for the month of February? What is the trend of the market and how you should be trading in this particular choppy phase of the market? The sectors you should watch for. And lastly, we always make it a point to give you one derivative strategy which would help you smoothly tide over the February month using the option segment. So, January series was a month where we saw a massive correction in the Nifty index. Almost from the all-time high levels of 26,350, there was a one-way steep fall in the index, which saw the Nifty getting below the levels of 25,000. So historically, we did highlight in our previous webinar, if you heard us out, about weakness which we anticipated for the month of January. We also gave you the exact levels which worked absolutely fine for a trader who followed our levels which we discussed in our monthly webinar. One more key highlight for the month of January was the India VIX, which is the volatility index. Now, historically, it is known that whenever a significant event comes up, your VIX has a tendency to rise. So, before the event, with the steep fall in the market, there was significant buying input options, which triggered the India VIX to rise all the way from its 9% base to around 14.5%. That was a massive 77% gains. Rollovers for Nifty, which is how the positions were shifted from the month of January to February, stood around 71-72%. That was in line with the historical averages. And with a roll cost of 0.5%, it probably signaled that short positions were rolled to the month of February. So this is a brief background about how we started off for the month of January. Now, for the February month, what we look forward to. Now, one of the key events is behind our back. This was the mega event. This was a game changer. And whatever fears we had about the budget are done and dusted. The positives are known, the negatives are known. And now with one clarity, we can step forward for the month of February with more confidence. One more great thing which has happened is that the US-India trade deal, which was in the making, which was more of a suspense for the last 3-4 months, is finally out. Now people know there is more clarity that there is a support for the market. The tariff rate has come down to 18% for India now. The kind of disturbances or the fears which one had before are all put to rest. Now only some clarity is awaited more on the details of the deal which has gone through. But that is also behind our back. So now, with these two events being done, the volatility index has crashed from 14.5 to around 12% as it closed today. So what does this mean is that the fear is slowly moving out of the system. That is point one. Second, VIX crashing by over 15-20% in the past 2 days signals that probably the market is eyeing 25,000 as a possible bottom for the month of February. So we have a scenario where volatility is in, but it is cooling off, and 25,000 more or less is a bottom in place. That's what our volatility index has to signal. Bank Nifty rollovers, because Bank Nifty is normally a leader of the indices. Bank Nifty setup is still positive in a broader sense. We almost clocked in all-time high levels for the Bank Nifty index a couple of days back, and we are back in the range of 58,000. That's our support. 60,000, which is our resistance. Again, Bank Nifty is slowly catching momentum ahead of the RBI event, which is due on this Friday. And with a rollover of 71% versus its 3-month average of 75%, clearly short positions were hesitant to build for the month of February. So Bank Nifty is the stronger index. So if you have to make a choice whether I would buy Nifty or Bank Nifty stands to be the preferred choice of index. Nifty index, your major call writing position is at 26,000. The call writers were in for a major surprise yesterday's trading session when Nifty opened with a gap of over about 700 to 800 points. There was panic in call writers all the way from 25,000 plus strikes, those who anticipated further fall in the market, and they had to cover up their short bets in the market, which led to such a strong gap up opening as it stood yesterday. Now, historically, if you would ask me as to how February month plays out, seasonally it's a volatile month because budget is the key driver for this month. On an average, February returns have shown a 2% returns over its prior closing, and this figure is heavily skewed by a few exceptional years. So if I were to put a percentage terms as to what is the strike rate for a positive return for February, roughly it stands 57%. It is known for its high volatility and sharp falls in 6 out of 10 times. That's what the history has to suggest. So we are bracing ourselves for volatility. That's what the key takeaway is for the month of February. If you look at the chart for the Nifty, which is I have placed below, clearly we are still above the trend line support. So on the technical parameters, we have exactly bounced from the support of 24,900. There is a chart gap because of a strong gap up which we saw yesterday. And whether this gap would fill or not is a question mark. But in all likelihood, my sense is that at least for the month of February, a support is in place. 25,400 is the immediate support which I would look for if you are a trader with a weekly perspective. Even if 25,400 would break, let's say because of some XYZ parameters, it is not a panic. 24,900 comes into play. So all in all, I believe 25,000 is there to stay. So 26,100, 26,200 is the positive upside projection of target right now, going by the current data and price indicators. This is the working target you can have in mind on the Nifty index as we move further into the month of February. Now, next slide, if you look at it, if you were to see as to which are the possible stocks or the sectors which would benefit out in the next wave of positive trades if you see in the Nifty. So clearly, post the budget, post the US trade deal. Now, you might say that why are we not looking at sectors where beneficiaries may arise because of the US in their trade deal? The reason is that we already have a positive circuit moves in majority of the stocks. So we are not looking at them. We are looking at data points and not on just sentiments. So finance, financial services space, banking, and oil and gas. These are the three sectors that you have to have on your watch list, pinned on your board, because these are the three sectors which we believe should do well for the month of February. Which sectors are vulnerable to profit booking? Already the first round of profit booking has struck the IT space. There was some negative news today as the day started, and that has triggered off a massive fall in the IT names. But I believe this is more short-term or temporary in nature, and one should not really go by the strong downside. You can say a steep fall which we had. I think that should soothe the nerves, and we should see a temporary relief rally coming in the IT space soon. But if I were to talk about a negative outlook in any sector right now, it is the IT names, and that is for the short term. A key development in this budget was that the STT on index future trading was hiked from 0.05% right now to 0.02. It's almost a 150% rise. This makes your trading expensive, and in index options it has increased to 0.15. So clearly the government is making its intent clear that it wants to curb speculation. Now really, does this hamper the overall budget? My answer is no. Yeah. So STT has increased. The government has made its intent very clear that it wants to curb speculation, give more impetus to investments, and this is more of a short-term knee-jerk reaction. I really do not believe that this is a scare in the market. People who trade on leverage, people who are used to trading in the futures and options space, who have good timing, they will be ready to bear this additional costs and still place their trades in the futures and option markets. Obviously, the volumes, how it plays out in the next 3 months, will have a lot to say, but I don't think it has major implications, at least from an F&O trading perspective going ahead, though there might be small loss of volumes, but I do not see major loss above 5 to 10% loss of volumes for the exchanges because of this move. So the next slide, if I were to take you through, is on the FII action. Now there are two different data points I'm presenting to you. On the left hand side is how the FIIs have been positioning themselves in the cash market and how they have been positioning themselves in the futures market. And the numbers are not that great. Clearly, if you look at the cash market, the numbers, the red numbers, the selling numbers continue to pile up, at least in the cash market. And in futures market too, similar is the situation. Now, the only positive silver lining which I see in the futures market was data which came out in yesterday's market post the US-India trade deal. There was massive short covering from the FIIs. The long short ratio, where we talks about the percentage of long bets to the percentage of short bets, has improved from 7% longs, which was seen last month, to around 16% longs, which stand currently. So that's a significant change, and that is primarily because of short covering, where short positions were covered by FI to a great extent after the positive reaction of the market to the Indo-US trade deal. So that is the silver lining for the market. There is an intent that positive buying positions might be built by the FIIs in the coming days. In fact, if you read the yesterday's data points, there was roughly buying of around 6,000 odd crores in index futures, which is a massive number if you look at the averages. So clearly there is a shift happening, maybe not in cash, but at least the leverage positions in futures are signaling that slowly the numbers or the positive intent of the FIIs, at least in the leverage market, may come out very soon. But we will keep you updated on this in our reports. So it is the initial stage, but I think you need to keep a tab on how the FIIs play out in the coming days. Now, if you look at the positioning of the FIs which we spoke of, the clients too are positioned on the long side. If you look at the clients, when I say clients, it is the HNIs, the high net worth individuals, the normal retail clients, people who trade in the market are having an exposure of 72%. We are not talking about the prop test. We're not talking about what the institutions are doing. It's only what the clients are doing. So they too stand on the long side. FIs are on the short side, slowly twisting to the long side, although too early to indicate, but there is an intent being seen. So what would be the key levels to watch for the month of February? As I mentioned, 25,400. Please note these important levels down. I would be positive on the short-term scenario of the market till 25,400 holds, expecting it to go up till 26,100 on the upside. This is the working target for the Nifty for short-term traders. And worst case worst, if even 25,400 support breaches, 24,900 is a massive support, and the probability of this support holding for the month of February is very high. And the all-time highs can be retested in the coming days. That is what the recommendation we are suggesting. And primarily, this will be driven by heavyweights of the index. So if you would see a positive way in the market, today IT sector was down almost around 7%, but still the index managed to hold on to its gains despite IT being a laggard. So that clearly shows the strength of the market post the Indo-US deals. Now, events what you need to watch in the month of February, which will dictate or be the important triggers for the market. Obviously, it has to be the India-US tariff updates, because the tariff deal has been done, but still the minute details on different sectors as to how they will be taxed, how the tariff plays out in them will be awaited. The RBI policy on Friday is an important event, although it's more of a non-event in terms of a rate change. Liquidity infusion is talked about in this particular event, and if RBI does infuse and takes measures to infuse liquidity, that will be taken as a positive momentum for the banking sector per se. FII flows, keep a track on it on a daily basis. Any green numbers, if slowly picks up in the cash segment, any short covering intent in the future segment, these will be read positively for the month of February. The long short ratio is what you need to keenly track. Do read our reports and where we do mention about how the long short ratio is playing out. And global tensions, because US and Iran relations are still on a heat. It's very difficult to predict how things change there, but the global tensions continue and they would have an impact on the market on the short-term scenario. Lastly, as I mentioned, we always make it a point to give you one of the best strategies which we feel should work out for the month of February. We have designed a ratio put spread. Now, the beauty of this spread is that it works in 3 market scenarios. It gives you a limited profit if the market goes up from here, limited profit scenario even if the markets were to stay sideways, and in case there is a marginally bearish signal in the market, a slight fall in the market by around 2% from the current levels, that would be the best case scenario for us by using this strategy. The strategy is all about buying 1 lot of put at 25,000 strike for the 24th monthly February expiry, and simultaneously selling 2 lots of 24,900 put for 24th February. So when you sell 2 lots, you are selling or getting an inflow of roughly around 40 odd points, because there's an outflow of 57 points when you buy a put. But net when you set this strategy, you are getting a credit the moment you enter the strategy of around 40 points. This is the positive factor of this strategy, and I have shown you the payoff in the table below. Wherever Nifty has to go on the upside, don't worry, you are getting in your 40 points of profit. Sideways market, you are taking in 40 points home. If it closes or expires below 24,850, that's the best case scenario, where you clock in easily around profits of 7,000 to 9,000 roughly. The only risk is if we have a steep slide in the market below 24,750, then we have. Yeah, so I believe there was a small hitch. I'm sorry for the delay, but basically we are done through the presentation. We have given you the best strategy which would work for the month of February. It's a bear put spread. The strategy is slightly on the bearish note. In case the expiry is at 24,950, it will give you the best of the returns. Even if the market would not correct that much, still the strategy benefits by the inflow which you get. So I believe this is one of the best ways to approach the market in the month of February if you are strategizing yourself using the options. So just to sum up or to conclude how we would go about February, first of all, do not expect February to be a smooth ride from here. It's going to be a choppy session. It's going to swing both ways, but 25,400. Be ready for upsides till 26,100 to 26,200. These are working targets for the Nifty index, and we would like to stick to this positive view till 25,400 is held. Even if it breaks, do not panic. There is no risk. It is only that from a positive setup from short term, things get neutral, and in that case, the range of 25,000 to 25,700 comes into play, and the market broadly remains choppy within this range. So these are 2 scenario analysis for you. It's going to be a choppy ride, but follow the sectors which we mentioned for you, follow the strategies which we gave, follow the levels which we recommended to you, and I believe in all probability your February month will end up as a profitable month with our advice. So thanking you on this note, and open the forum for the question and answer session.
How to generate monthly income by selling options of underlying in stock?
Yeah. There's always a question about how you generate monthly income in stock markets, and so what you do basically is that you have a portfolio in place, and against the portfolio you get access to margins from the broker, right? So what you do is if the stocks which you are there in your portfolio are eligible for that margin benefit, then you start writing options against these stock holdings. So majorly these writing in options would be in the stocks having exposure in the futures and options segment. For example, suppose you are holding Reliance in your portfolio. Then you need to come to us at the beginning of the month when a new series starts, and we will recommend you the apt strikes where calls have to be sold or where puts have to be sold. The net objective of this strategy is to write options which are roughly 8 or 10% away from where the stock trades at the beginning of the month. We will make a proper analysis of these stocks and recommend you which strikes to go for, and try to generate 1.5 to 2% return on the margin which you are using as a collateral. So roughly, with this approach, even if you were considering some months which may not go your way, the whole idea is with the free margin which you utilize from your portfolio, with the risk-free kind of a return which we are trying to generate over and above that, even if you make 7 to 8% kind of a return using margin from your collateral, this is how the HNI community plays for, by writing options against your stock holdings. So this is normally the strategy which most HNIs follow.
Please share the open interest analysis reading.
See, if you look at the open interest analysis reading, what you do at the beginning of the month is you need to see where the highest bars are in the open interest. When I say a bar, is that where is the highest put writing in open interest, where is the bar of the call writing in open interest. So for example, I will just simplify this with an example in Nifty. Right now, if you see the Nifty index for the monthly 24 February expiry, the highest put writing in terms of total open interest is at the strike of 25,500. So that is the support zone. And 26,000 has the highest bar of calls in open interest, which is the resistance zone. So clearly, you know the levels that 25,500 is your support, 26,000 is your resistance. Now, when Nifty hits either of these levels, there's where a trade initiates for you. So when, suppose Nifty would correct to 25,450 or 25,500 in the next couple of days, you need to monitor how open interest is playing out at the strike of 25,200 in put. If there is shedding, it means the support is losing its validity and you generate a sell call. If there is no significant shedding despite Nifty touching or getting below your highest open interest bar, it means the support is in place, and then you hunt for buying trades. So this is how open interest analysis is used for a layman. That's the basic way you try to use open interest to your advantage.
Please explain how bull or bear trend can be predicted by derivatives rollover on expiry.
So here what you have to do is that you have to see the rollover numbers for the month. You have to see the average rollovers for the past 3 months. So for example, for the Nifty index, right now the rollovers for the month of February stands around 71%. The average rollovers for the last 3 months was around 72%. So they are in line. So that's not a major deviation. You correlate this with the price action. If the prices for the month of January was negative, so clearly there was short positioning for the month of January. It means that average rollovers, if your current rollovers are in line, shorts have been positioned in the month of February. Now, if there was some major deviation in this data, for example, again 72% average rollovers, if rollovers for the month of Nifty was somewhere, let's say 65%. For example, you can take Bank Nifty, which was 71% against the average rolls of 75%. January clearly was a month which was weak for Bank Nifty. So there it was very clear that sell rollovers were lesser than the averages for the month of February. So that is the stronger index. That is where you hunt for buying opportunities, and that is how rollover analysis is done. Similar way you can work out for your stock positions also. See the price trend, see the open interest build up for the current month where the rollovers are, and see the historical averages, and then come to a conclusion about whether the rollovers are long or short.
How to select strike price and which direction should we take, either call side or put side?
So I think strike prices selection depends on the timing of your trades. Ideally, the premium depreciation of options, or the time value depreciation of options as you call it, is the highest at the near the expiry or near the closing of the expiry a week before. Premiums do not depreciate faster in the beginning of the month when the new contract of the futures and options start. So if you have a view on a particular stock where you are expecting a massive move, let's say you're expecting a positive move of over 4 to 5% in a given stock, and this you identified at the beginning of the month, then in such a case you opt for buying an option of deep out of the money strike. You can either go for strikes which are 4 or 5% away from the current market price. So deep OTM options can be bought, puts can be bought, calls can be bought depending on a view which you make at the beginning of the month. But deep OTMs can only be bought at the beginning of the month. At the expiry time, since their time value hits you the hardest, that is the time when you do not go for deep out of the money options, you go for at the money or in the money options. So this is how options strikes are selected depending on the timing of the expiry, as to where exactly you are placed, whether at the beginning of the month, the mid-month or the closing of the month.
Please share the role of India VIX in options trading.
India VIX is a fear and greed index. It tells you at a given point of time whether an option is expensive or an option is cheap. A rising VIX means options are bought, options are getting expensive. A falling VIX means options are sold and stability is getting back in the system. India VIX and Nifty are inversely correlated. So if VIX is going up, it means Nifty should go down majority of the times and vice versa. So at the current level where Nifty is, the VIX is cooling, it means the writers are back in the system, and the writers or option writers are back in the system when they see stability or when they see a definite range play in action. So falling VIX is always good for the market. Rising VIX means there is fear and greed, and that is the time when you should be on alert.
Thank you, Akshay.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.